My encouragement today would be to build out your skill set, become more rounded, read a lot of books, think about the world, think about how to make a good decision, because those are the elements of the economy that are going to be most difficult to automate.
Peter, welcome to the third season of the Land and Everything Else podcast. We're so happy to be with you today. I really appreciate the time you're giving us to sit down.
Well, thanks for including me, Craig. I'm excited to be here.
Yeah, well, thanks for coming. Well, Peter, if you want to share a little bit about yourself and what you do over at Granite Creek, we'd love to share with our audience.
Sure. Yeah, we just hit our 20th anniversary, and actually last night we celebrated it with a big party.
Oh, I love it.
I'm one of the co-founders and partners of Granite Creek Capital Partners. We are a Chicago-based lower middle market private equity and private credit investment firm. Along the way, we've done some other entrepreneurial things. We have a farmland fund, which I think is what intersects your world most closely.
It does.
We also started a real estate finance business called Renovo Financial, which is a short-term lender to people who are in the fix and flip residential housing investment business. That's a national lender in 30-some markets with a few hundred employees. Most recently, we launched a specialty agribusiness fund focused on operating businesses that are in the upstream agricultural value chain. So think of suppliers to farms, ranches, things of that nature. I also serve on a couple of investment committees and have a broader perspective on asset allocation and other aspects of the investment market through the investment committees that I serve on.
Well, ripe for conversation today.
Good.
I'm quite excited. So I want to start with the intersection and talking about the farmland fund that you've got. One of the things that we've talked about a lot on Land and Everything Else is this idea that we can make a compelling case for farmland in a portfolio. We can look at its dynamics of, correlation with equities and bond markets. We can look at it as a fairly stable source of value over time. I think one of the issues of getting into farmland is the initial capital that we often see. If you were actually going to go buy an operating farm, the amount of capital you would need for that. And then, of course, the business risk that you're taking by just buying that one asset. When you look at investors in the farmland fund y'all have put together, how do we go about mixing that in a larger portfolio? And, what kind of investor characteristics have you seen as far as demand?
Yeah, that's a great question. So when we started on an institutional basis buying farmland, it preceded the major run-up that we've experienced in land prices over the last last really 4 years.
Yes.
There's been a major appreciation in the farmland, across America, but, particularly in the areas that we focus on in central Illinois and a little bit into Indiana. And so at that time, it was opportunistic. Farmland had a pretty quiet 10 years prior to our entry. Cost of money was far lower than it is today.
Yes, it was.
And the annual cash flow that we could earn on that land exceeded our cost of money.
Sure.
And so the math just worked.
Yes.
Buying a piece of farmland at really a compelling cap rate. It was financeable through third-party mortgages. We work with commercial banks, farm credit, organizations like that. Today, the equation is much more difficult to buy farmland as an institutional investor. So when I think about farmland and how it's positioned in a broader asset allocation and potentially a family office type of investment portfolio, it really is over the long run an incredible store of value.
Yes.
There are nice cash flow dynamics that allow you to get paid to wait for the land to appreciate. And depending on how you see the world, there are some compelling macro elements that I think really favor owning an asset like farmland in the
Well, sure.
Midwest, where we have plentiful rainfall, lots of fresh water, and other things that are, really elemental to farming and, more broadly, life.
Well, on a macro standpoint, global calorie demand isn't going to be getting smaller, right? And our friend Dr. Bruce Sherrick has a conversation he tells about how as other parts of the world develop, they tend to eat higher quality proteins. Those proteins then also consume calories, right, from effectively corn, beans, that kind of Midwest. So
absolutely,
your demand for yield on a global macro scale, there's a big thesis to be made that we will need more and more and more yield over time, which inevitably impacts land, right, where we're growing those things.
Yeah, and some of the major growing areas are pretty water depressed. I mean, when you look at irrigated farms in places like western Kansas or, western Nebraska that have been drawing on their aquifers, and now all of a sudden they have dry farmland and their productivity is down 60, 70%.
Absolutely.
It's a reminder of the privileged place that we are in Illinois and Indiana and other parts of the Midwest.
So on our earlier conversation there, interest rates are higher, borrowing costs are higher. Farmland, traditionally, the actual yield you're getting, is a bit lower. How do we make the math work today on if we're leveraging farmland? How does that work out?
So today we're not a buyer of farmland.
Okay.
We have traded around some of our portfolio where we have sold some assets, put the capital into a 1031 account to exchange it then on a tax-free basis for other land that is better positioned to optimize our portfolio.
Okay.
I think if you are a buyer of farmland today and you have a long-term horizon, call it, 10 plus years, I think you're mostly a cash buyer.
Yeah.
And you're viewing that asset as just a long-term allocation to something that historically has appreciated at a total return that's above public equities.
Yeah.
And I think that's a compelling place for an investor to be looking right now when a lot of other assets that are, more commonly held in an investment portfolio look pretty expensive to me.
Well, and I think as far as if you have long-term holding, the case for farmland still persists today, even with higher interest rates. If you're going to hold the thing 10, 15 years, that's when you start to see farmland move, when you start to see things go in the market and that end, can be very productive.
I mean, one of the best ways to make money is to not lose money. And thanks to a pretty high floor in farming these days with very compelling insurance and subsidy programs that are supported at a federal level, that the floor is quite high in farmland. And so the notion of boom and bust farming that would have been, the common perception a generation ago, I don't really see that existing today. And so if part of an investor's goal is to not lose money and to park capital into assets that offer stability and cash flow, I think farmland is a great place to invest no matter the time frame. And if you have concerns about other assets being potentially overinflated, farmland is, again, it's an attractive place to store value. And if you compare that to, say, like a municipal bond, which would be another low yielding, cash flowing asset, you're not going to make any money on your municipal bonds on at least the bond itself. You're going to make the cash flow.
Correct.
And if your bond is moving in price, most recently it's moved down. You've lost money on your municipal bond because of the movements in interest rates. So I don't think that's a particularly compelling gamble if you're looking to store value, earn current income. Farmland is a much more attractive investment from my perspective.
Well, let's pivot a little bit to the agribusiness fund that you've got. If you share a little bit about how the demand momentum and how that's been going for you guys.
Yeah, I'd be happy to. So to your earlier comment on the global protein consumption trends, that's really where this started for us.
Got it.
So in 2009, we had a business that we owned that was distressed. And this is a company that manufactures electric forklifts. It had been a family-held business that we had acquired a significant interest in 2007. And as you know, those of us old enough to remember the 2008 financial crisis, that was not a great economic time.
It was not a great economic time if you were borrowing, yeah.
And so this business that we owned a significant portion of, that we were a lender to, saw its revenue decline 70%,
Oof.
you know, some highly material amount as capital equipment spending really disappeared. One of my partners and I were sitting at a conference room table at the company's headquarters, and we were asking ourselves, who really cares if this business survives? And one of the names that we came up with was a Chinese supplier of the company's entry-level product.
Okay.
And we said, hey, let's call these Chinese guys. We don't know, anything about them. We actually thought the name of the company was different than it was.
Okay.
I'd never been to China before. And next thing we know, a couple of weeks later, the principals of the Chinese manufacturing partner came over to the States to help us evaluate this transaction.
Okay.
So to make a long story short, we enlist their partnership to restructure and recapitalize the business and embarked on a really wonderful 10-year relationship with our partners in China. And, to go a little bit off on a tangent.
Oh, yeah,
what
please.
ended up happening with this business is it's very unlike the typical business story that involves China that you hear, where all of a sudden you're decimating factory jobs in the U.S. We probably increased employment at our U.S. facility in Wisconsin fivefold over the course of the investment that we had in this business. But anyway, back to how this ties into global protein demand. I started going to China anywhere from 2 to 4 times a year over the course of, call it 10 years.
Okay.
And every time I would fly over, leave the airport, start heading to the home base in Hangzhou, about a few hours from Shanghai, you could just see the rapid pace of change in these urban areas and even these surrounding areas to the major metropolitan areas where everything was being urbanized. You'd go out to dinner and the menu was changing. You could just see the rapid development of the Chinese economy into something that resembled much more like our economy here in the States. And so, after a few years of doing this trip, I said, how do we participate?
Yeah, how can
in
we
this
be part
economic
of
miracle,
this development
without being a Chinese investment firm investing in China?
Got it.
How do we invest in America and
be part of that global growth?
Exactly, where rising tides would lift all boats.
Yeah.
And so we really came to the conclusion quickly that agribusiness was going to be one of the great beneficiaries of this global protein demand trend that was in a major way being driven by the rapid changes to the Chinese population and economy. And so we ended up making an investment in a business in Wisconsin that was involved in the dairy sector, taking dairy waste and remnant whey protein and concentrating the protein, selling that on a commodity basis as a milk replacer for calves, things like that. But then we also produced a fermented product that was fed back into a cattle ration for health and nutritional purposes, and then had some other pretty interesting end markets. I can't say that that was a great decision for essentially what we were at the time, like tourists in the agricultural sector.
Okay.
To have gotten ourselves neck deep into a business that was very much part of the agricultural supply chain. But that's what put us onto this journey and really helped us build the network that we have today.
Absolutely.
That is all now culminating into this agribusiness fund that we are in the process of putting together. We've had our first closing, and we're going to raise capital through the end of the year to get this off the ground.
I would think you've got some pretty hot demand there too.
Yeah, I mean, the private equity market is certainly favoring specialty investors. We've done a lot of deals around the agribusiness sector over the last 5 years in particular. We have what I think is the preeminent agribusiness team in terms of the operating partners and advisors that we've added to the mix. At the end of the day, agriculture it's an insular business. And it's not to say that all business isn't about relationships and how people connect. There are very, very few businesses, in my opinion, that totally disassociate with the human element of a transaction. People want to do business with people, right?
Yes.
And so by bringing experts to the table, people who are deeply entrenched in livestock, deeply entrenched in row crops, other elements of livestock like poultry that we didn't used to have great coverage in. We were always really deep in beef. Now we've got great coverage into poultry. We're getting coverage into the equipment side of the ag market. And so our ecosystem can really benefit an operator of a business where they might otherwise see capital partners simply as just money, as a way to diversify their own wealth, as a way to finance a growth initiative. What we're bringing to the table are people who are going to help them grow their businesses. And so that's the differentiated edge, and why a specialty sector fund like this one is attractive to the institutional capital market.
Oh, I can see huge dynamics at play with the specialty sector fund and agribusiness. Let's pivot again. You talked about one of the areas of recent growth was being able to be a short-term real estate lender, kind of in the market of fixing up or moving things quickly. How did that come to pass? With kind of, you got farmland, you've got agribusiness. I'm kind of wondering the tie-in into that world as well.
Yeah, that's another story, I'd say, of zigging when the world is zagging.
I love it.
And we met an entrepreneur coming out of the financial crisis in 2010.
Okay.
And banks just didn't want to make short duration loans. And
not at that time. Absolutely not.
And banks really were trying to reduce their residential real estate exposure, having gotten a little drunk on that sector.
Handed it to them a little bit in 2008.
Very much so. Yeah. And so we were presented with the opportunity to make a loan, really to back a business.
Okay.
And I'll give you an example of the first loan that we made, which was to a borrower who had a really good credit score, bank quality borrower, had a job in the IT department of a major bank, very stable income, was buying a house in the suburbs of Chicago. He was going to provide 30% of the equity of the transaction.
Okay.
And our loan at 5 points up front, 15% interest, 6-month loan or 6-month duration of the loan was more attractive to him than bringing in an equity partner.
Okay.
And he ends up buying the house, flips it in 6 weeks. Everybody's happy, and he became a repeat borrower. And so fast forward today, that model is not as thickly priced as it once was, for obvious reasons. The housing market is very much evolved in the 15 years.
It has.
But it's become a volume game. And really what we're selling in that business is it's not that we're selling money and that's our product. We're really selling service.
Okay.
And so, it's a very competitively priced business now. It's a volume business. But when you are a an investor and you were fixing and flipping a single family house or a small multi-unit property, what you want is a lending partner that really understands your needs, that is thinking about kind of the time frame that you're trying to operate on, coming out and doing an inspection as quickly as the work is being done by the subcontractors, so that the project can move as quickly as possible.
So not only is it money, it's connections, right?
Absolutely.
It's the system. It's everyone. It's everything in place to keep this moving fast. It's everything in place to keep this. I would imagine to some extent, even, the connections to people doing the work is probably you can help with all those too.
Absolutely. And then, we employ a bunch of people who go home from work and they watch HGTV. This is their lives.
Their love.
They're in it.
Right?
Yeah. And so that business has been really great. We'll, originate billions of dollars of loans this year. The servicing portfolio has scaled far larger than any of us envisioned. We have an incredible management team there that we supported quite intensively for the first 10 years of the business. My partners and I were the credit committee. We knew the borrowers' names, we knew the assets, and we got a very strong start. Yeah, but they have just scaled so quickly and greatly that, now we're just really happy, largely like passive investors in the business today. One of my partners sits on the board, but it's been a great sector and helped open our eyes to real estate investing, which, then ties a little bit back into the farmland investing.
Yeah. So all three of those stories, I think, have that common core of seizing opportunity, right? Seeing opportunity and then investing, committing, and building systems around the opportunity. Is that sort of a talent you've had your whole life? Is that something you built the team with? How is it you're 3 for 3 with that at this point of the game? It's a pretty good flow through, I think.
Yeah. It's not to say that we bat 1,000.
Okay.
And you take risk, you're going to swing and miss a few times, but we have a really great team and we communicate extensively. We share ideas. We argue. We figure out what is going to make most sense for the good of all. And, as we build consensus around the things that we've really decided to lean into, very fortunately, more often than not, things have worked out really well.
So I'd love to get your advice. Yes, the podcast hits a lot of financial professionals and landowners and some brokers, but I'm also a professor at University of Illinois, and I teach undergrads. I teach seniors who are in a capstone class. Mm-hmm. And so if you were giving some advice to seniors today about their future, their careers, what would you give them? Let's say you got a room of 50 of them looking at you right now. What kind of advice might you give that crew? Because I love your entrepreneurial success in this world, and what would you share with them?
That's a great question, and it's something that I have thought about recently as I get inbound inquiries from students thinking about their own careers, and also just thinking about the skill set of some of the younger people on our team and what that might look like in 5 years, 10 years. And my answer to that question has really evolved quite recently.
Okay.
And 5 years ago, 10 years ago, I would have said, go take a lot of accounting classes, learn as much as you can about Excel, be able to build a financial model, become a real practitioner of the financial elements of the investment business, if that's the career that one wants to pursue. Today, it's not that the understanding of a financial statement and how a business's cash flows work isn't critical. That is still critical to our business, mm-hmm. any investment business, and frankly, any business that one is going to lead as an operator or as an investor.
Sure.
What seems to be on the horizon is really a sea change shift in the technology tools that are going to be able to automate a number of those functions. And so when you think about what are the skills that are going to be most important going forward, you're going back in time to some extent to ability to communicate, critical thinking, how well can you write, And, for a lot of the undergrads coming out of the, major Midwestern schools who were in business majors, part of investment banking clubs, et cetera, that they've been deeply, deeply focused on becoming financial modeling machines. Okay. And my encouragement today would be to build out your skill set, become more rounded, read a lot of books, think about the world, think about how to make a good decision, because those are the elements of the economy that are going to be most difficult to automate.
I agree with that wholeheartedly. One of the beautiful things about this season of our podcast is AI and automation tools have come up across the board, across professions, right? Talking with a wealth manager at a firm in town, a partner at a wealth management firm, and he and I were talking and talked about automation, and AI tools, or maybe not even AI tools, but just tools that move things forward. Yesterday, I had a chat with somebody about in an education framework, same conversation. You and I are talking, same conversation. It seems like there's just a general trend of a lot of the analysis that was on young entry-level people is kind of moving to automated analysis. And now it's more important that we are able to interpret that and create connections around it and move forward.
I think very much so.
And it's just interesting to me to see industry, and everyone, all the industries are kind of going, well, you need to understand the outputs, but a little less focus on necessarily maybe you doing the Excel than it used to be.
Definitely. And we're not there yet.
No, we're getting there though.
The guys in my office spend a lot of time in Excel, and they're building PowerPoint presentations, as we have for years, but you can see they are starting to use some of these AI tools
to speed up a little bit.
Absolutely. And you can see how that's going to shift their time and attention to things that look more like critical thinking and communication.
I like where that's headed. Well, thank you so much for coming in today. This has been a great conversation, man.
Good. Well, I really appreciate you having me. It's been a pleasure. Thanks, Craig.
Thank you.